You open your January 2026 paycheck and bump your 401k savings higher. You are 55. You have done this before. The extra catch up dollars should slide in pre tax, shrinking the taxable wages on that stub. But this time, payroll may split the money. Your regular contribution can still go in pre tax. The catch up portion, the dollars above the normal limit, may have to go into Roth instead. After tax, same retirement account, different tax timing. This is not a new tax rate. It is not a ban on saving, and it does not hit every worker over 50. The real question is narrower and more expensive than it sounds. Will your extra catch-up dollars still lower today's taxable paycheck? The twist is that the answer does not start with your total income. It starts with one very specific wage number from one very specific employer. Here is the practical breakdown. Not panic, not rumor, just what changes, who gets caught by it, and what you should ask your payroll or benefits team before the first 2026 paycheck is processed. The common assumption is too broad. High earners are not automatically losing all pre-tax contributions to a 401k, 403b, or governmental 457b plan. The rule is aimed at catch-up contributions. That means the extra amount workers age 50 and older can contribute after they have already used the normal annual limit. That distinction matters. If you are affected, your regular elective deferrals can still be pre-tax if your plan allows it. The dollars at risk are the catch-up dollars above the standard cap. Those may have to be treated as Roth contributions, which changes when you pay tax, not whether you can save. So we will build this in order: the old catch-up privilege, the secure 2.0 change, the wage test, what Roth actually means, the delay to 2026, real examples, and the questions to ask now. To understand what is being taken away for some workers, you first have to understand what the catch-up privilege was designed to do. Think of the normal contribution limit as the main highway. Each year, the tax code sets a ceiling on how much of your paycheck can go into a workplace retirement plan as an elective deferral. If your plan allows pre-tax contributions, those dollars can reduce taxable income today. If your plan allows Roth, they can go in after tax. Then, at age 50, a second lane opens. That lane is the catch-up contribution. It exists because real careers are messy. People start saving late. They leave the workforce to raise children. They lose jobs, change employers, recover from medical bills, or finally reach higher earnings in their 50s. So Congress allowed older workers to put in extra dollars above the regular annual limit. The sequence matters. Your first dollars are ordinary elective deferrals. Once you hit the regular cap, the next eligible dollars become catch-up contributions. Same paycheck system, different bucket. And that bucket only exists if the employer plan offers it. A 401k may allow it. A 403b may allow it. A governmental 457b may allow it. But the exact limit, the timing, and the available tax choices depend on the year and the plan document. This is why the new rule is so easy to misunderstand. The catch-up feature is not a bonus account sitting somewhere separate. It is a payroll classification that appears after the regular limit is used. But Secure 2.0 did not remove that extra lane. It changed the tax road some people have to drive it on. That change lives in one specific place, Section 603 of the Secure 2.0 Act. Before this section, an older worker could usually make catch-up contributions the same way the plan allowed regular deferrals: pre-tax, Roth, or sometimes both, depending on the plan. Section 603 added a new condition. If a participant is subject to the rule, then catch-up contributions to a 401k plan, a 403b plan, or a governmental 457b plan must be made as designated Roth contributions. That phrase matters. Designated Roth does not mean the money goes into a separate individual retirement account. It means the dollars stay inside the employer plan, but they are treated as Roth dollars. They are included in current taxable wages. They do not reduce taxable pay in the year contributed. The trade-off is that qualified Roth withdrawals can come out tax-free later. So Congress did not erase catch-up saving for higher earners. It changed when the tax bill is collected. The old pattern said, save extra now, possibly lower taxable income now, pay tax later. The new pattern says, for certain workers, save extra now, pay tax now, and build Roth money inside the plan. That is the cause and effect at the center of the law. The catch-up lane remains open, but for affected participants, the pre-tax turnoff is blocked, and the entire rule now turns on a deceptively simple question. Did you earn more than the threshold from the same employer last year? The threshold begins with a specific number, $145,000, but not just any $145,000. Under Secure 2.0, the test looks at your wages for FICA purposes from the employer sponsoring the plan in the prior year. In plain English, that usually means the wage amount tied to Social Security and Medicare payroll reporting from that employer. Not your household income, not your investment gains, not your adjusted gross income, not the size of your brokerage account. That is the first trap. Imagine two workers who both feel like high earners. One has $135,000 in FICA wages from her employer, plus rental income, dividends, and a spouse with a large salary. Her total household picture may look far above the threshold, but for this specific rule, those outside dollars are not the test. Another worker has $155,000 in FICA wages from the same company sponsoring the plan. Even if he has no investment income and no second household earner, he is much more likely to be inside the Roth catch-up rule. Same paycheck system, different result. The second trap is the employer connection. If you made $200,000 at Company A last year, then changed jobs to Company B this year, Company B does not automatically treat those old wages as its own for this test. The rule is focused on prior year FICA wages from the employer maintaining the plan. That is why a job change can matter. And by 2026, the dollar figure may be indexed above the original $145,000 amount. You may see references around $150,000, depending on inflation adjustments. But the framework is the same. Prior year FICA wages measured through the same employer's plan. And that wage definition is where many employees may misjudge whether the rule actually applies to them. Here is the part that catches people off guard. Your salary on an offer letter may not be the number your plan uses. A worker might say, I make $150,000, so I must be over the line. But payroll may be looking at FICA wages, the wage bucket used for Social Security and Medicare tax reporting. That bucket can be affected by how your pay is structured, what benefits are excluded, and what your employer reports through payroll. So the shortcut is not, what is my title? Or what do I feel like I earn? Or even, what did I take home? The better clue is on your wage reporting, especially the Form W-2 information connected to Social Security wages. That is the kind of data employers and record keepers may use to decide who is above the prior year threshold. And once that decision is made, the cause and effect can be automatic. Prior year FICA wages above the indexed line. Payroll flags you. Next year catch-up contributions are treated as Roth if the rule applies to your plan. That is why two employees can sit in the same conference room, drive similar cars, and carry similar job titles, but get different catch-up treatment. One has bonus pay that pushes FICA wages above the line. Another has a different compensation mix and stays below it. The trap is assuming retirement rules measure income the way normal people talk about income. They often do not. And once the system decides you are above the line, the next question is what Roth treatment actually does to your paycheck. Think of the catch-up dollar as taking one of two doors. Behind the pre-tax door, the dollar goes into the plan before federal income tax is taken out. Your current taxable wages are lower. You still owe income tax later, when money comes out of the account, but today's paycheck gets some relief. Behind the Roth door, that same dollar does not reduce your taxable wages today. Payroll still counts it as income for federal tax purposes. You pay the tax now, the contribution lands in the Roth side of the plan, and if the Roth rules are met later, qualified distributions can come out tax-free. Same contribution limit, different tax timing. That is the whole mechanical shift. Not a penalty, not a bonus, a timing change. But timing can feel very real when it hits your paycheck. If you expected a pre-tax catch-up to shave down your taxable income in 2026, and payroll instead treats that catch-up as Roth, your take-home pay may be lower than you planned. The retirement deposit still happens, the tax benefit just moves from the front end to the back end. For some workers, that may be fine. They may want Roth money because they expect higher taxes later, or because tax-free income in retirement gives them flexibility. For others, it may be painful. They may need the current year deduction, especially if they are managing tuition, mortgage payments, medical bills, or a high-income year. So the rule does not declare Roth good or bad. It changes the default path for certain catch-up dollars. But the biggest misunderstanding is still ahead. Being above the threshold does not mean all of your 401k deferrals become Roth. Here's the line that matters. The new Roth requirement is aimed at catch-up contributions, not your regular elective deferrals. That means a higher wage worker does not automatically lose the ability to put normal 401k contributions in pre-tax. If the plan allows pre-tax deferrals, those regular dollars can still go in before federal income tax, up to the standard annual limit. The switch happens when the dollars become catch-up dollars. Picture a 55-year-old employee in 2026 who is above the wage threshold. She contributes from January through the fall, and her regular deferrals are still treated as pre-tax because they are under the normal limit. Then she reaches that limit and wants to add the extra age 50 catch-up amount. That extra layer is where the Roth mandate can apply. Same worker, same plan, different bucket. The regular deferral bucket may still be pre-tax. The catch-up bucket, because she is age 50 or older and above the threshold, may have to be Roth. This distinction matters because the headline can sound much bigger than the actual rule. It can sound like high earners are being pushed entirely out of pre-tax retirement saving. They are not, at least not because of this provision alone. What changes is the tax treatment of the extra catch-up space. The rule draws a line between the base contribution limit and the age-based add-on. And in payroll, that line is not philosophical. It is a code, a field, a classification that determines whether the tax break shows up now or later. So if this rule was written into Secure 2.0 earlier, why are so many people only hearing about a 2026 deadline now? Because the original timeline was much tighter. Secure 2.0 was signed at the end of 2022, and the Roth catch-up requirement was supposed to start after 2023. In practical terms, that gave employers, payroll teams, record keepers, and plan administrators a very short runway to rebuild how catch-up money moved through the system. And this was not just a legal memo problem. A payroll system had to know whether a worker had more than the wage threshold in prior year Federal Insurance Contributions Act wages from that same employer. Then it had to identify when the worker crossed the regular contribution limit. Then it had to route only the catch-up portion into Roth treatment, with taxes withheld now instead of later. That is a lot of moving parts for something that can happen quietly inside one paycheck. So the Internal Revenue Service stepped in with Notice 2023-62. That notice created an administrative transition period for taxable years beginning before January 1st, 2026. Plain English. For that transition window, plans would not be treated as failing the new rule merely because catch-up contributions for affected participants were not made as Roth. That did not erase the rule. It bought time. Time for payroll vendors to add fields. Time for record keepers to test coding. Time for employers to figure out whose wages count, especially when people change roles, move between divisions, or receive different types of compensation. This is why the 2026 date matters. It is not when the idea first appeared, it is when the relief period runs out. And that behind-the-scenes complexity creates one more practical issue. Some plans may need a Roth feature just to keep offering catch-ups to affected workers. Here's the design problem. The law does not just tell certain older, higher-wage workers, your catch-up has to be Roth. It also puts pressure on the employer plan to have a place where Roth money can actually go. That sounds obvious, but many plans were built with only pre-tax salary deferrals, no designated Roth contribution feature, no Roth election screen, no Roth source sitting inside the record-keeping system. So in 2026, if an affected worker is required to make catch-up contributions as Roth, a plan without Roth may have no clean way to accept that catch-up. The employer then has choices, and none are as simple as changing one line on a form. It can amend the plan to add Roth contributions. That means plan documents, payroll codes, employee notices, record keeper setup, and testing the money flow before the first affected paycheck hits. It can limit catch-up contributions for the group subject to the Roth rule, depending on how the plan is structured and what guidance allows. That avoids taking money the system cannot properly classify, but it also means a worker who expected extra retirement room may not get it, or the plan may use a deemed Roth election approach. In plain English, the system can treat catch-up dollars as Roth automatically when the participant falls under the rule, while giving that person a chance to change elections in the way the plan permits. That is where the personal tax question becomes a plan operations question. You may prefer pre-tax, your neighbor may prefer Roth, but your actual options depend on payroll data, plan language, software fields, and whether the administrator can separate regular deferrals from catch-up dollars at the right moment. The easiest way to see it is to put two employees side by side in 2026. Take a 55-year-old employee named Maria. In 2025, Maria earns $170,000 in FICA wages from her employer. That is above the secure 2.0 threshold, assuming the indexed amount lands below her wages. In 2026, she is still with that same employer, still age 50 or older, and she wants to make catch-up contributions. For Maria, the catch-up bucket is no longer a pre-tax bucket. Her regular 401k deferrals may still follow the normal plan choices, but the extra catch-up dollars, the dollars available because she is age 50 or older, have to be treated as Roth contributions if the rule applies. That changes the paycheck. A pre-tax catch-up would reduce her taxable wages today. A Roth catch-up does not. So if Maria puts in the same catch-up amount, her retirement account may still grow, but her current paycheck withholding can look different because she is paying tax before the money goes in. Now put her next to Daniel. Daniel is 52. In 2025, his FICA wages from the same employer are $90,000. In 2026, he also makes catch-up contributions. Daniel may still be able to choose pre-tax catch-up, Roth catch-up, or a mix, depending on what his plan allows. His age alone does not trigger the Roth-only rule. The prior year wage test matters. And then there is the job changer. If Daniel earned $200,000 at a different company in 2025, then joined a new employer in 2026, those old, unrelated wages are not the core test for the new plan. The rule looks to wages from that same employer, same age group, same catch-up concept, different payroll history, different result. And this is where the rule becomes less about Roth versus pre-tax and more about how much control workers really have over the timing of their taxes. That is the bigger turn. Congress did not erase the catch-up contribution. In fact, the Internal Revenue Service had to step in with Notice 2023-62 because the original wording created a strange fear that catch-up contributions might accidentally disappear after 2023. The notice said no, catch-up contributions can continue, but for certain higher wage workers, the tax treatment changes. The extra dollars are still allowed into the plan. They just may have to enter through the Roth door. That means the real shift is not savings versus no savings, it is tax now versus tax later. And that is why this rule feels so personal, even though it lives inside payroll code. Your age matters. Your prior year FICA wages matter. Your employer's plan design matters. Then the payroll system has to recognize all of it before your paycheck is cut. One number on a W-2 can quietly reshape a choice you thought belonged only to you. So if you are over 50, the question is not just, can I make a catch-up contribution? The sharper question is, will my catch-up still be pre-tax in 2026? So the original question has an answer, but it depends on 3 checks you can make before 2026. Here is your checklist. First, look at your 2025 Form W-2 from the employer sponsoring the plan. The key number is your Social Security wage amount, not your taxable income, not your household income, and not wages from a different employer. Second, ask Human Resources or Benefits whether your plan has a Roth feature. If it does not, the employer needs a plan design answer before the rule becomes operational. Third, ask what happens in payroll if you are over 50 and your prior year FICA wages exceed the indexed threshold. Will your 2026 catch-up election be automatically redirected to Roth, Or will you need to make a new election yourself? That resolves the open loop. Your regular elective deferrals up to the normal annual limit may still be pre-tax unless your plan has its own separate restriction. The change targets the catch-up layer for certain higher wage workers, so your pre-tax option does not necessarily disappear across your whole 401k. But the extra catch-up dollars could stop lowering your taxable paycheck in 2026. That is the quiet lesson here. Retirement rules can look like fine print, but one payroll definition can change when you pay taxes. If you are planning to use catch-up contributions in 2026, comment below. Has your employer explained the Roth catch-up change yet? Thanks for watching.